So once again, welcome, everyone. We're finally on Chapter 7. We're week 6, so we're getting right through this. Not too much more to go. And tonight's class, we will be talking about captives and captive insurance. And so, if you kind of think about the progression of what we've gone through so far, I think it's a fairly logical sequence as we talk about the role of insurance and self-insurance and how the fundamentals of that, retrospective programs, and now we go to captive because what you'll see is now we're kind of, this is, if you want to call it a hybrid, or I wouldn't quite call it alternative financing techniques, but it's now under a captive we can do a lot of different things under the same premise of a self-insured, as well as the retrospective. We can do some things in there, and you'll kind of see that in the reading that we had for this chapter. On the objectives, we have fairly short, but describe the purpose and characteristics of a captive insurance plan. So we'll be going through a lot of the charts on there, helping explain what some of those are. Because I know in the book it wasn't necessarily that intuitive in some cases of how they've described those. Describe the types of captive insurance plans that are available. And it's probably this section that you'll get some questions, usually in the past, if I remember correctly, the difference between, you'll have maybe a definition that describes the type of captive, and then you'll have to say whether that's a protected cell, a group captive association, so on. Describe the advantages and disadvantages of using a captive insurance plan. And of course, there's a long list, or at least a long list on advantages and fairly short on disadvantages. And so we'll certainly usually some questions out of that. And then finally, we'll be able to describe the following considerations performing and operating a captive insurance plan. And these being, some of the basic steps, but you're going to need to get a little more detail as we go in there. But conducting a feasibility study, operating as a reinsurer or direct writing captive, basically what does that mean? Selecting the lines of business, setting premium arrangement, and determining the captive domicile. And this is basically, when you look at that, really the steps you would take as you start making a consideration of forming a captive. And I would say basically looking how the UC formed its captive, you kind of look at all those steps, and that's exactly what we basically did. Is those are the types of things we made determinations on, and also what we think what we might do in the future on the different lines of coverage to have that in the end in mind, so your captive is appropriately established. So when we think about captive insurance plan, I mean, we have the definition in there, but the way I would just to make it easier in your own mind is it's your own insurance company. Essentially, a captive is, just as the name sounds, it's captive to, in this case, a parent organization or group, and it's an arm's length away relationship. So, the definition, it's a subsidiary form to ensure loss exposures of its parent company or companies and affiliates whose primary purpose usually is to reduce the parent's cost of risk. And so, again, it's an arm's length away organization. It's going to have its own corporation, but it's a lot of times the members of the board of directors might be the same people that are on the board of directors of the parent organization. But essentially, for IRS purposes, it needs to be arm's length away. The domicile of where the corporate headquarters are, or its incorporation status, is part of that. But essentially, the parent company controls the insurance company. It would reap any dividends the insurance company would make. And for the most part, most captives don't write coverage outside of their own operations. They certainly can, but then it's doing a little differently, operating a little bit differently, and it's operating more as a insurance company. Now, some insurance companies, as we talk about, an agency captive, they may form a captive to do exactly that, to write coverage. But again, just the idea of a captive, it's really just an arm's length away insurance company. And so, I'll address that question. So one of the questions, which I think, so I'll have people remind me if I don't, to address during the class, if a state organization, like a university or a state government, could create a captive insurance plan. I can say they can, at least for universities. For our case, that we were able to, the University of California formed a captive. It was approved by our Board of Regents, but it really has to do from the constitutional aspect. of it. Now, most likely a state agency would not be able to form a captive. They usually would self-insure, but actually it depends on what the regulations. If the legislature said they could form one, now I think about it, they probably could. It's really on the basis of what the state allows, and also how the state insurance regulations, whether it's admitted insurer, those type of things. I think for state aid to be tougher, but I think a university certainly it would certainly be able to do that. As far as the relationship of a captive to its parent, as I mentioned, it's very similar to any others. The captive is going to collect premium. It's going to issue the policies and pay losses. It's a similar relationship as it would be with any other insurance organization. The difference is that it can control its destiny much better through a captive. And we'll talk about the rates it can charge and those type of things. It's usually for very large companies and involves purchasing captive reinsurance as well, or involves the captive purchasing reinsurance. So the difference here, we'll talk about why would you want to do this over being just a self-insured. And typically it has more to do with tax implications. So we'll probably cover this a little bit later, but I think this is good to cover now just to give it some context, is that if you're a large self-insured organization and you have, in California or any other state, and you have these losses, what happens is that you're typically reserving, you're funding, you have an account to fund the liabilities. So you're setting aside, let's just say $10 million to pay for these. But of these, we know the payout schedule is only going to be, it's going to take 4 or 5 years before you actually pay that $10 million out, but you set that money aside. So there's an opportunity cost associated with it. The way the IRS works is that you can't recognize that expense until you actually pay it. So even though you've set aside that $10 million, you only pay $1 million the first year. That's the only business expense you can deduct is that $1 million. When you buy insurance and you purchase, you're purchasing a policy, and this is what it talks about later in the book, and if, let's say I had to pay that $10 million for that policy, that full $10 million is recognized as a business expense right then and there. And so the tax implications of that, of the cash flows, it talks about cash flow, that's one of the primary reasons why organizations look to do a captive. The other issue is, as we kind of we'll talk about excess insurance here as well, is that if you remember when we talked about excess insurance earlier, is that you have to notify your excess insurer once you hit 50% of your self-insured retention, because then they take over the control, essentially, of that claim. Under a captive, you would basically have complete control over that claim for the entire time period. And even with a reinsurance relationship, because you're now using reinsurance instead of an excess, the reinsurance basically pays for the liability. They do not manage the claims handling of it. So again, you have much more control under a captive insurance plan. So let's move a little more. So kind of going right to the pictures, and this is one of those that may be a little confusing. So the idea of, you have the parent or the insured down here. So this, let's say this is Home Depot, to give it some context. So Home Depot, which I believe also has a captive, they would be down here. And if you look at these lines, just so you can see, when the small arrows are lost payments and the big arrows are premiums. So what this is basically saying is that we're going to, as a Home Depot, we're going to pay a premium up to the captive insurer, which is Home Depot excess, or excuse me, Home Depot captive, whatever name they give it. And then when there's any type of losses, they're going to make loss payments directly back to the insured. Okay. If there's a payment to be made. The other thing, it talks about third-party losses. So what this arrow basically means is if we have someone slip and fall in one of the Home Depots, in which there's a claim and it reaches the level where the captive insurer has to pay, then essentially this is where we would, the captive would be paying directly to the third party, and that's why there's this only one line here. Now again, actually I need to clarify, on the loss payments from the captive to the insurer, if we have a loss in which the idea that we had someone, a work comp claim or something where it's our own people that we have to pay, we pay it out. They're going to reimburse us directly. And so that's why that loss payment's going back to us. It's once we reached past our deductible or our self-insured retention, Anything beyond that that we pay, the captive reinsurer simply is indemnifying and holding us harmless. Okay. Now on this layer, the captive insurers, we talked about on reinsurance last week, the captive insurer is then going to buy reinsurance. So they're paying premium to this reinsurer, and then if the captive has a loss that pierces the reinsurer layer, then they're going to be making loss payments essentially to indemnify that. And then you have these different little arrows here that talk about the first party loss, the relationship. These are the contracts relationship or the insurance policy. Here's, this is the ownership of it, and this has to do with the insurance policy. And then between the reinsurer and the captive will be essentially a reassurance agreement that will be part of it. So essentially, that's how this relationship works. Also, now what this slide tries to do, which I think makes it a little more of a challenge because of they need to have a little line over here. Basically, the idea under retained or transfer losses, and this is like a hypothetical captive, is that there's two ways, as we talked about on the reinsurance market, how this might work. You can have a per occurrence reinsurance, meaning that let's say this per occurrence attachment point was $1 million. So any claim over $1 million, the reinsurance would kick in specifically on that policy. And then also you can have what they call an annual loss aggregate. And so what this is saying on the, so if we, from an annual standpoint, once we hit a certain point, and what they're trying, if we added all these up, it's basically saying, okay, we hit that point. Then all of a sudden, any future claims past here, if we drew a little line, anything past this point right here, all future claims would be paid by the reinsurer on the aggregate excess reinsurance. And the idea being, let's say this is $10 million. So after $10 million we've paid out as a captive, anything else will be picked up by the excess reinsurer on going this way. So what this is dealing with is a frequency issue and this is really a stop loss. So as a captive, then we can be assured, sleep at night, that our worst case scenario at some point, if we have a $10 million annual aggregate, we're not going to pay more than $10 million ever under this captive. And essentially the reinsurer then takes on that risk. And the only way the reinsurer would take on that risk is if the likelihood of this piercing this layer would be very, very rare, or they'll charge the appropriate premium essentially to cover that in the event it does. But again, if you think about reinsurance, it's for catastrophic, it's for unusual events, kind of more unplanned or unexpected. So over here, again, it talks about losses that are retained by the captive and losses transferred by the captive, and that's really all that the dark lines are showing, as we've really talked about. So now we deal with, as they kind of talk about, a captive insurance plan combined with excess insurance. And one of the things that's unique about this is that essentially what they don't show is, well, they kind of show the captive down here, and then they, the captive's beneath here, under this little line, and then they don't really show the parent down here. But the idea is, under this arrangement, what they're trying to show is that the reinsurance amount is up to $1 million with a $250,000 retention, okay, the captive retention. So the idea is that the captive, if we have any claims, the first $250,000 is owned by the captive. If we have a claim that goes 200 and let's call it 300,000, then at that point the captive would pay the 250 and the reinsurer would pay the 50,000 on that claim. Now, what it talks about in the text down here is they said essentially it's the organization, the parent organization is retaining it. The reason why is because the captive is most likely going to pass on the 250 back down to the parent. So the captive retained it. It may be that the policy is that the parent pays, it's a first, they're retained up to 250. It depends on how it's set up. But the assumption they're making under this example is that any of the captive's costs are going to be passed on directly down to the parent organization to absorb that first 250,000 self-insured retention. Okay, so that's the way they've set this up. Now, then the reinsurance is up to $1 million, and then they have excess on top of it. I know they put this in here. I'm not sure, to be honest, that this, I don't know how often this really happens, where excess, because normally reinsurance would be up in the millions of dollars typically. But what this does by this arrangement, it gives control of the claim under the reinsurance, the captive and the parent essentially down to this layer, and then it would transfer at this point once you get to the excess layer. And this goes up to 26 million, the way this is set up. So it's an arrangement, and they talk about that you may be able to do it. Most likely you're probably going to do more reinsurance, and you're probably going to do excess in this regard, but it's how they show it. Now, again, understanding the graphs, that's really what we're trying to do, and from the text that they provided, and I'm not going so much reading all the material, because I think that the graphs are, if you can explain this, as I said, then you should be able to understand the material and pass the exam. So you have two options, and this kind of goes back to what I was talking about, whether if you're self-insured, you can, this is a layer that's covered by a captive, and you can either do one of two things. You can either buy excess insurance or you can buy reinsurance. The limits are the same. We have 1 million. So, there's not a whole lot of difference there. But the first 250, once it's covered by the captive, you only have this layer, and then excess kicks in, which basically means they're going to be controlling the cost as an excess typically. They're going to be taking over. They have more jurisdiction once you buy the excess under that type of policy. Under a captive, you own the entire risk up to this $1 million up to you get the reinsurance level. And again, this is probably more of a likely scenario that you would most likely see there. Under the characteristics of what they talk about common captive plan is it's going to be hybrid. What that hybrid means, it's retention and transfer. You're retaining a certain amount of risk, and you're going to transfer some of that risk on there. And that transfer can be a transfer to essentially the reinsurance at some point. The types of losses that we're going to have under captive are low to medium. So just like any other things like self-insurance, a captive is really just another form of self-insurance. So, the claims in which you have a pretty good idea of frequency, that they're going to happen. If you think of what the ideal type of insurance, or what type of the type of claims to have in insurance or to retain, that's what we're talking about when we talk low to medium. When we talk about high, that's our catastrophic claims. Severity of losses, those catastrophic, that's when we want to have insurance, and that's where the reinsurance would typically kick in. In most cases, you're always going to have a funded captive. Just like an insurance would have to be capitalized, and so that's why it's going to be funded. And it talks about the administrative requirements are quite high. And we'll see why these are so high, just because unlike a self-insured plan where you're kind of doing things and you just report to the Office of Self-Insured Plans, you're now an insurance company, which now means you have to comply with the state regulations, capitalization requirements, IRS filings. It's just much more involved when you form a captive. So that's usually why you see most large organizations, like you said, a Home Depot, a Safeway, Walt Disney, those type of companies, almost all of them are going to have a captive to manage their programs. So we're going to go in detail on each one types of these. So this first part that we just talked about is, what's the purpose? Why would we want to do it? And hopefully, you should be able to answer the question of the characteristics of a captive, that you would buy reinsurance and how the layers would work. That's the items we just covered. Now we're moving on to the types of captives. And most likely, this is where you will see a question on here. Is the most common is going to be a single parent captive, and then you have a group captive, a risk retention group, which is an unusual type of captive, and we'll talk about why those were formed when we get to that. An agency captive, rent-a-captive, and protected cell. But you want to definitely know the difference between all of these. So this is one you want to highlight to make sure you do study. So a single parent, or what's considered to be a pure captive. It's a captive insurer owned by one company that insures all or part of the loss exposures of that company. It is considered to be a hybrid plan because there's retention involved, basically on the form of a captive as well, or the parent company, and then it also transfers. And again, the loss retained by the captive are in effect retained by the parent. And that's what we're talking about before, is that 250 that the captive retains, essentially it is the parent that's truly retaining those losses. So as a captive, when we talk about a single parent, it is, as it says, owned by one company. So it's just Home Depot. It's just Safeway. It's University of California. And typically under a single parent, they're not going to insure any other programs outside of their own parent or their subsidiaries, because it also has to be set up in such a way to allow, and if it's set up that way in the very beginning, it can, but most companies are not in the business to run insurance companies for everyone else. This is seen as a risk financing plan, not as a opportunity to make money off of other companies for the most part. Usually requires at least $2 million in premium to be viable. And so the reason why the $2 million is kind of the mark there is because all the feasibility, setup costs, all those type of things, there's really no tax benefit for most organizations until you have a pretty large premium that you would be paying anyways, and it's probably better to just be self-insured at that point. Under a group captive, and so group and association captives, they pretty much operate somewhat similar, at least in structure, but the idea is a group captive by name. It's owned by a group of companies, usually operating similar businesses rather than a single parent. So just like self-insured groups or a joint powers insurance authority, the idea is several companies, they decide that they want to form a captive together. They're separate, and then their board of directors would consist of the owners of those various parent companies, and then they would operate this insurance company to their benefit. More common, I would say, is an association captive, which is essentially the same idea. It is a group captive, but it's sponsored by an association. In order to actually buy insurance from that group captive, you must be a member of the association to buy it. So there's a pest control captive that's formed by a pest control association. And so in order to buy insurance, you have, one, you're a pest control company, you're a member of this pest control association. By that fact, now you can buy the insurance from this captive. McDonald's basically has, and this is, you can say, okay, is this a group or a parent? It's a parent captive, but if you think about it, the franchises that are non-owned by McDonald's, they can't force the McDonald's company, unless it's in the contract, to buy insurance from them to buy it. So usually there's an association captive. They're formed for these franchises, to which then they can decide that, since they're McDonald's, they're going to go and buy insurance from the McDonald's captive. So that might be something. But typically you're going to see associations that will form these captives and then offer that, because then it's also a benefit to the members. And then typically the board of directors of the association are then managing the captive, or they have certain people that they appoint through an election process that will essentially manage the premiums for them. And again, it's a good way to keep losses down. The other reason why you want to do an association is that if you think about it, as an insurance company in general, they're insuring a bar, different types of an auto dealership, trying to think different bookstore, all these different types though. They're really diverse. That's what insurance companies generally write. The idea of association or group is that you have like exposures, you can better manage those, and so your loss control programs can be dedicated specifically to the captive, to your members. So if you know the business much better, and then also you can set the rules up that these people that want to join in, you can make it a country club. You can say you have to have these type of loss control measures put in, and so you have a lot more control from an underwriting standpoint to make sure that your members are doing what they're asked to. So that's why captives can actually save money when you do that. And then depending on the design, can be a transfer or act as a hybrid plan. I would say probably still most of the time they'd probably be hybrid, but they can set it up as a captive to where basically it automatically, any losses, it's almost like a first dollar, they set it up. And maybe what they're doing is they're just trying to get to the reinsurance market, and maybe that's why they might do it. But I would say most cases it's probably going to be a hybrid plan. Now, a risk retention group, or RRGs, these are unique, and they have very special rules. And so it's a group captive formed under the U.S. Liability Risk Retention Act of 1986, and its intent is to provide liability coverage, except for personal insurance, employer liability, and workers' comp. So under risk retention group, you can't, when we talk about personal insurance, that means you can't write health care. That would be considered personal insurance. Employer liability, so employer practices liability, or workers' comp. So really the only thing you can write are general liability loss exposures, professional liability, auto plans, things like that. And so part of the reason why that was set up this way, and this is probably more the history, but I think it's important for you to understand, give it some context, is that because workers' comp laws are different in every state as far as how long and coverages, the idea was that the state should still have some jurisdiction on what can be covered and the types of plans offered to make sure it's legit. Because under the rules and benefits down below, as you'll notice, the main benefit is that it only needs to be licensed in one state to provide coverage in any other state. So in order to write coverage, if you're an insurance company and you want to write coverage in California and provide work comp coverage, well, you have to be admitted and you have to follow the rules of the state. Under risk retention group, the idea is that if you domicile in one state, you're automatically admitted to every other state. And so what risk retention groups typically would do is find the easiest state to form, the cheapest, the easiest, and then offer coverages, because now the state insurance commissioners have no jurisdiction over them whatsoever. And this has been an issue that's been in the courts more recently, and that's why it indicates that some states are litigating the regulatory oversight. There was a couple risk retention groups in the last couple of years in California that are outside. They're formed in Montana and try to come in and write personal insurance. They're trying to do health care, but call it as a cap or stop loss program. The state insurance commissioner basically gave them a cease and desist order and was essentially going to sue them if they continued to write coverage. And so they were pushing the boundaries. And there's a risk retention association that was trying to push this, and there was an attempt in Congress to try to rewrite the laws. So risk retention groups, so the main thing, after giving you all this, you need to know is it's only really for general, provide liability coverage only, but it cannot be health insurance or workers' comp or personal line. Under risk retention group, the other issues, all owners must be from the same industry. It must be insured by the risk retention group, and all insureds must be owners. So what this means is it's like an association. As a group, the association has to be from the same industry. So let's say it's pest control. They would form a group. They're all pest control companies. They would all be owners of that company, and so doing in which they write coverage. So they would actually have to be kind of like a member owner, and so then there's joint and several liability associated with forming this, and so that's really the main benefit there, is that you can form it and you don't. It's cheaper than forming, going through all the exercise of a captive and having being basically regulated by various states. So. And then you have an agency captive. So an agency captive is owned by the insurance agents or brokers rather than by the organizations insured. And what the idea here is, it indicates in the book, it's formed in response to hard markets and allows agents, brokers to assume some risk and generate underwriting investment income. So if I'm a big broker or an insurance agent or insurance company, what I could do is, rather than, in some cases, I may form, in this case, maybe more of an independent broker. You'd form a captive, an agency captive, and this would allow us to write some coverages that we may not normally write. Because of the hard markets, the pricing level, I might be able to get my prices a little bit lower than regular what the market is. And what's happening is, it says you assume more risk in doing this, because your underwriting criteria, you can create your own underwriting criteria when you do this. So there are a couple agency captives out there. To be honest, I'm not sure how many there are, how well they're used, but there are certainly agency captives that do exist. And of course, you asked for an example of an agency captive. I want to say that Marsh, as a broker, has formed an agency captive, which is domiciled in Bermuda, but you can't quote me on this, but for some reason, I'll try to look some up, but I know that there are some agency captives, and they're formed with a very specific purpose to either cover like medical malpractice or certain hard to write coverages, and so they have different kind of management, but I know that there are some out there that exist. And I'll see if I can't find some literature on them and then post them up on the website so that people have access to those. Then the others captives, then we have two others, which is rent-a-captive and protected sell. So rent-a-captive are kind of unique, and from what I've heard aren't that popular anymore. They were popular at one point. But the idea is that it's an arrangement, and this says in here, which an organization rents capital from a captive insurer to which it pays premium and receives reimbursements for its losses. And the insurers keep their own premium and loss accounts, and there's no sharing of losses, and allows for quick set of the captive for tying up. So the idea is that there would be a captive already set up, and what you're basically doing is you're going to, when it says rent capital, it's kind of like you're borrowing money, the capital to be able to pay for the losses, so you don't have to set up your own. When we say rents, that means there's some interest probably charged as part of it. So in so doing, I'm going to pay premium to this captive, and I'm going to receive reimbursement for it. And so the insured in this case, so if I'm Home Depot and I decide to do this, I would keep my own premium and loss account, so I would take care of my own accounting, but there's no sharing of losses with anyone else. So under a group captive, I'm sharing my losses with, with a pest control. I'm going to share my losses with the other pest control companies, and the success of the captive is based upon the success of the whole. Under a rent-a-captive arrangement, I'm just saying I just want to carve out my little area. I'm going to pay premium, and so that way I'm not affected by others' losses. So that's one area. The protected sell is very similar to rent-a-captive, but in this case, it protects the participant's assets and surplus in the event other participants become insolvent. Okay, so the idea being that under a rent-a-captive arrangement, if for whatever reason the original captive fails, you're pretty much out. So, I mean, even though you might be doing well, but overall the captive can't maintain, and it falls under itself. Under protected sell, the idea is that your assets, surplus, all that, you're not affected by any of those type of areas, and so that's why they call it a protected sell. You're more likely to see, if people do this, you'd see a protected sell company rather than a rent-a-captive in this regard. For testing purposes, you don't need to go in that much detail as far as different examples. What you basically want to know the difference, of they're going to define, they're going to describe something, a definition, and they're going to say, okay, which one of these is this? And then you'll have your choice of, group, association, those type of things. And most likely the question is going to have to do with group and association because they're very similar, but the key words in there are going to probably be that they're part of of like companies that have joined together, and you have to be a member of this, type of thing. So they'll use some type of words like that to describe it. So the question is, why would you rent a captive instead of just a self-insurance? Well, it really comes down to tax implications again. The idea that, again, if you self-insure, now for government entities, we don't have to worry about the tax implications. But for private sector companies, their main consideration is its cash flow and having high reserves and maintaining that money. So to give an example for the UC, I want to say that our funded liabilities, so this is what we have sitting, if you want to call it sitting around, that's earning interest, I think is in excess of $300 million. So that's $300 million that's not available to do other things with, build buildings or whatever. It's not operation. We need that to pay the liabilities. On the other hand, if you're, if you're under a rent-a-captive arrangement, if I pay premium, at least I can count that and deduct it from my operating expenses, so my tax liability goes down. So, so that's really what the main benefit in most cases is going to be of why you'd want to do a captive versus self-insurance. And that's where the feasibility studies actually come in, is that when you looked at doing a captive, there may be other considerations of, in California, for a lot of times there's not a benefit to a public agency doing a captive. But for us, because of our size, there definitely was, but for most of them there probably isn't, to be honest with you. So what are the advantages of of a captive, and we'll go through detail on each one of these. But the idea of, we talked about reducing the cost of risk, benefiting from cash flow. You want to make sure that you highlight and the differences or the definitions of each one of these, what it describes. And most of these should be fairly obvious if you think about it as we go through what those benefits really are. So the first one is reducing the cost of risk. So when we do this, it reduces the underwriting expenses, overhead costs, and allows for investment income from premium. So when we talk about the cost of risk, that's what we're going to pay a normal insurer. We're paying for someone to do the underwriting. We're paying the insurance company to have their overhead costs. There's the profit that's in there, and also, as I mentioned before, the investment income that we will now earn, that investment income rather than the insurance company. So if we have that $300 million that's sitting there that we've capitalized, that money now will essentially be available, to earn interest, and we will be the direct beneficiaries because now that helps pay for the claims rather than being necessarily a profit motive as such an insurance company would have. I mentioned benefiting from the cash flow. Investment income earned due to payout patterns and benefits of retrospective programs. So I'll talk a lot more detail about this, but the key point here is that the investment income, if you think about payout patterns, let's say for workers' comp, 95% of the cost is paid out in the first 4 years. So if we know that the typical that maybe half is paid in the first couple of years, the money that we collect to fund that reserve, we're going to earn that interest income now. So we can stagger that money that we have in the liability fund to make sure we have cash flow. The other benefit talks about retrospective. You could actually develop an insurance program instead of just being guaranteed cost. You can develop the program so it's retrospective. What that means is that you're not, from the prior classes that we talked about, depending on when the losses occur, you'll pay a certain amount, and then you set it up under retrospective that you pay when those losses actually occur. And so now you're saving your dollars. Those premium dollars go to pay out what the expected losses are over that period of time. It also allows for actual experience. So even though we think we're going to have $10 million worth of losses, we only have $5 million, under a retrospective program, we can directly benefit that $5 million right now. And because we see what that payout pattern is and those type of things. So that's the idea of benefiting from cash flow. And as you can tell, most of these are private sector terms. As for public sector, we would still benefit from the cash flow because it makes more available for other uses for that. Obtaining insurance not otherwise available. They mentioned environmental, professional liability. I also put in there TRIA coverage. So for the university, or actually for anyone, getting TRIA, terrorism risk insurance coverage, is rare, but it's underwritten by the federal government. With our captive now, we can go directly to the federal government for that TRIA coverage, which was not available because no one else was providing it on there. So we go directly to and that goes to the next one, which is direct access to reinsurers. The obvious point in there is if you have direct access, you're going to cut out the middleman essentially by doing that. Actually, I put it twice there. And also, you can capture the ceding commissions, meaning so the commissions that would be paid to a reinsurer would pay to the primary insurer under a normal arrangement. They're actually paying commissions to that. Those commissions would basically going back to a director, they would be charged, and so the costs to the captive would be much less. And also, obviously, you get better terms. Negotiating with insurers. So if you have a captive, there's a possibility, just as we have programs in the captive, and we have programs that we're still buying coverage for. What that allows us to do, and depending on whether it's a hard or soft market, we can now kind of negotiate, and we have some options because we have if someone here's the rates and they really want our business, we can say, we'll just move them to captive. They're going to hopefully we'll get better premiums because of the captive that we haven't set up that the others wouldn't have that bargaining power, and so there's help there. Centralizing loss retention. The idea that if you have organizations, whether worldwide or different parts of the country, instead of having programs set up with the different laws of workers' comp, I'll give an example. If you're self-insured, let's say the company you used to work for Raley's, and you need workers' comp coverage. Well, you have to, if you're self-insured, you now have to apply for self-insurance in California and New Mexico and all the states in which the organization operates. And so you're dealing with, let's say you're in all 50 states, now you're dealing with 50 self-insured offices in every single state which you must comply. Or you can buy an insurance policy that may cover all those, but then the insurance company's dealing with that. Or, this is where this gets to the point, is if you're a captive, you now provide workers' comp coverage automatically, and now you can provide that in all states, and now you're centralizing that loss retention instead of having to do it in each individual state and have different security requirements. So that's the idea of under captive. It's really beneficial for those organizations that operate in several different states, or especially internationally as well. Potential cash flow advantages on income taxes. I talked about that quite a bit. I think that's one of the major drivers for most organizations, is the premiums are considered a business expense. You can control losses. And the reason why this is so important is that the more you can control your losses in the very beginning, you receive the direct benefit. If you're in an insured program, it's going to take some time. So, controlling losses, the immediate savings come whether you're self-insured or you're a captive. If you're buying insurance, you're not going to see those savings. And then the other part is obtaining rate equity. And what that means, it's not intuitive. This is probably the one term that's probably not intuitive when you talk about rate equity. Is the idea that if you're able to, well, I'll use medical malpractice for example, that claims are typically reserved fairly high if you have medical malpractice claims. And let's say you annually have about $20 million in claims that come in. But it takes a long time for those claims to be settled. And in many cases, maybe you actually do a pretty good job and you win because of the programs, and you only pay out $5 million of that $20 million. Well, the problem is that insurance companies see that $20 million. They don't see how the claims resolve over a period of time. You're going to pay really high rates for that medical malpractice coverage. And so the rate equity aspect is that if you can better able to predict your losses, you really know what the payout schedule is, you know what the patterns are, how these claims, the equity portion on the rates is that you're really, because you have a better understanding, you're giving yourself that advantage of what what the true costs are really to the organization. So that's where that rate equity basically comes in. Is your, I don't say risk averse, but you have a better understanding of the data, whereas the insurer's they're going to charge the maximum possible based upon the claims history, not on the payout history. So moving on to what are the disadvantages then? Well, the biggest disadvantage are capital requirements, the startup costs. You must capitalize a new corporation in order to pay losses. So if you're self-insured, you still have all those. So for example, let's say for UC, this is I think a good example. We would still have our old claims that we have liabilities for because we're self-insured. We'd still have to pay, have a funded reserve for that. But then we have to go into, if we decide we're going to form this new captive, include workers' comp and other programs, we have to put money to front it. We have to capitalize the program. So in addition to all that money that's sitting there that's there to pay liabilities, we need to come up with some money to say, okay, when we open the doors, we need to have, and the claim comes in the first day, there's got to be money there. And it has to be enough money for a potential catastrophic loss because the requirements, and it's going to depend on the state, they're going to have different capital requirements. I believe for our purposes, for UC, I think our costs were quite several millions of dollars to do that. Now it says in there, it could be 120,000 or others. I think most larger organizations, if you're going to do a captive, they're probably much more than that. Sensitivity to losses, but this is especially true in the early years. Until you get that capitalization, those losses could have you're going to have dramatic swings. Very much like you're self-insured, you need to make sure that the way the captive's set up is it can handle those sensitivity to losses. The next one is pressure from the parent company management. This is actually true even in self-insured groups, is that it's arm's length away, but there may be pressure to lower the premium, saying, sales are down, we need, let's lower the rates. And in some cases, the actuary says, well, this is how much money we need. And I've seen this happen with self-insured groups in California, and actually trusts in New York, where the board members, because they're owners, were elected through this association, have basically gone counter and made bad decisions. In some cases, what they call buy an actuary. They bought an actuary to give them the rates that they wanted. And so you can certainly have pressure from a parent company when a company is not making, when it's having financial difficulties, they might see that as a way to happen. So, good question. So what happens if the company goes bankrupt? So one of the requirements typically, and that's why the capitalization is in there, there's actually usually within the state in which they're domiciled, they're required to also maintain certain security requirements to do that. In some states, they also would have, they have to pay, in California, it's called SIGA. I think it's Commercial Insurance Guarantee Administration, and for California Insurance Guarantee Administration. And the idea is that anyone that writes insurance coverage in California is required to, for every dollar that they collect, that's maybe a penny, goes into the SIGA fund. And that fund is set up specifically for in the event that there's a failure, whether it be on the commercial market or in the self-insured. So in California, back in 2001, when the meltdown of the work comp market happened, there was like 80 insurers, and then all but 4 went bankrupt, where they left the state. And so then what happened is the SIGA fund then had to help pay for those because there's still losses, to pay for work comp claim for that. There's also typically in each state a self-insured security fund. In California, it's called SISF, S-I-S-F, Self-Insured Security Fund, which is for self-insureds that basically does the same thing. So it's not part of a captive, but in case in California we had a company that used to be called Homebase. They went bankrupt, and they basically could not pay their work comp, didn't have the capital, so SISF then picked up those claims and made sure that the injured employees were taken care of. So, very good question. So that's kind of built in there, is that the domicile agency will make sure, and usually there's some arrangements, potentially, the security requirements they'll have to go along with it. But, I mean, just like any company, that can happen. It could go bankrupt. Okay, and this kind of actually goes to the premium taxes of residual market loadings. And these are fees and taxes as regulated by the location where it's domiciled, which would include the fees I just mentioned, to make sure that if something was to happen, that those would be made whole as much as possible. So now we really move on to operating the captive. So when we talk about operating, the main thing, the consideration is first you need to conduct a feasibility study. And what they're including on here is, so what do you include in that feasibility study? Or what are they looking at to do this? And typically an actuarial firm, in some cases brokers would be involved, but typically the actuaries will be looking at this as well. So it'll include an income statement and balance sheet, to understand what the financial condition of the organization is, 5 years of projected pro forma financial results. What are the expected? What's the health of the company? Are they financially stable? That's the first 2 things what they're looking at. An accounting of the effects of all types of taxation, or an explanation of why certain tax does not apply. The idea, again, here is from a financial aspect, you're trying to look at the feasibility. Does it make sense? Are you going to be avoiding some certain types of taxes by forming this captive? Are there other taxes that if you do it that may then apply to the organization? And at least one scenario that portrays worse than expected financial results and that demonstrates management is considered the possibility of financial impairment. This is kind of like the stress test idea, that if the company had a bad year, as you kind of say, can it work? And what that also looks like is it helps give the idea of how much capitalization is going to be required to maintain that, because depending on that worst year, can they withstand 1 year? They can probably withstand 1, but if it's that first year it's in operation, that's why the capitalization comes in the scenario there. Then a detailed explanation of each assumption. such as expected loss ratio, interest rates, year-to-year growth rates. So again, we're looking at it's the financial health of the company. And also a model showing the minimum number of participants, premiums, and capital. And so when we talk about participants, premiums, and capital, that's really looking, we're talking more about group or association when you're doing the feasibility study. In this case, if it's just a parent or single parent captive, then you're mainly looking at premiums and capital requirements of what the organization, how much money can it take out of its operating expenses to basically to capitalize the organization. When you do an operating, as far as operating captive, a reassure or a direct writing. And so one of the costs that's associated with operating a captive is what's called a fronting company. And this goes to the idea of whether you're going to be admitted or not. And so as it talks about what a fronting company is, it's a licensed insurer that issues an insurance policy, or what we call paper, and reinsures the loss exposures back to a captive reinsurer owned by the insured organization. Okay, that's a mouthful. Basically, all it is that if I'm operating in another state and I want to write policies in California, I want to become so that if the regulations require that, I would need to be able to write coverage for others, let's say. So an example for UC might be is that we're looking, if we want to write coverage for, let's say, renter's insurance for students, as an example. We can't write policy. We can only write cover ourselves, because in this case we'd be writing policies for students. We would need to have an insurance policy to allow us to do that. So there's two ways we can do that. One, we go to another insurance company that isn't already admitted, or that is admitted in California, and say, we'd like you to issue paper on our behalf. And essentially what they're going to do is if there's any claims, all that type of thing, the premium they collect, they give it back to us. And then, if there's any claims, we pay for it and it goes through them. So they're just acting as a front for us. For them doing that, they would request a certain percentage of the total kind of captive program. And it indicates down here range from 8% to 30%. It depends on whether it's a hard or soft market of what they're going to charge. And so that's all that they're doing. They're just showing paper to provide coverage. In some cases, they may provide claims handling, loss control services for a fee. The other way, as a captive, that if I wanted to, write policies in a state to do almost like the third-party coverage I mentioned, is I can buy a small insurance company, and essentially now that I own it, they're admitted in the state. Now I can then write policies, and so that's another way that I can do that. So that's what a fronting company is, and that's what it talks about. When we talk about a reinsurer, it's a little different than a reinsurance, but as a reinsurer, it's basically a pass-through. That's what a fronting company is. A direct writing captive, it would issue policies directly to the parent. It does not use the fronting company, and in doing so, when we talk about direct writing, because we're only going to write policies to our own organization, to no one else, then we can do that, but we may have to follow what they call not admitted insured rights. In some states, they may have some regulations which we have to follow to do that. And every state's going to be a little bit different on what those not admitted insurance rights. For the most part, like for us, there's really no additional requirements. We're just direct writing only our own UC assets, and so we don't have that issue. We are considered direct writing captive. At some point, we may decide to do like the renter's insurance or something, if that was something we did, and then we would have to find a fronting company. So essentially, the way our captive is set up, we can actually do both in that regard. So the other considerations that are in there that they talk about in the text is selecting lines of business. So the idea of, workers' comp, so the WC workers' comp, general liability, professional liability, employer practices liability. The idea is, what are you going to cover? What are the business lines? That has to be some of your consideration. And the reason why that's important is because depending on what you're going to write, there's actually better locations to domicile. One thing I didn't know until fairly recently is that, I think it's, Cayman Islands is better to write, I think, for medical malpractice. They have captives. They're the way the captive formation rules or regulations work there. They're better for that than compared to others. And so it's important to have an idea of what you think you're going to write now and what you're going to write in the future. So the question that came in is, what set the premium rate in the captive program is the, make sure I read this right. So what set the premium rate in the captive program? Is it the injuries rate or the financial situation? Okay, so that's actually a really good question. Those are two different things. So the rate will actually be set by what the expectations, the premium collection will be set mainly by, what the expectations are, as far as the types of claims and the loss history, because that's where the rate comes in. But having said that, it kind of depends on whether the company can fully capitalize. So the idea is that they'll still need to capitalize it, which is different from the rate. So they're kind of two separate things. We need to capitalize the organization, pre-fund it, and then the rate that we set is what we're going to charge annually. At some point, because we set the certain rate, we may over-collect, and part of that rate setting is what confidence level we're going to set that rate at. And so over a period of time, it may help with our capitalization. The rate that we set may help with that. So that's the idea behind it. So typically the rate is, the actuaries will set the rate based upon what the loss experience is, but then they may include in there that, hey, you need to collect more money, and so they'll put that on top of it on there. So I guess it is really a combination. It depends on how much can be capitalized by the parent. So the other aspect is setting premiums. So the idea when we talk about setting premiums, are we going to do a guaranteed cost, a retrospective? What kind of insurance program are we going to set up for these different lines of coverage? And then based upon those two other factors, then we need to make a determination of domicile. And we can either do a foreign or domestic domicile, and we need to put considerations on there, the regulations and tax considerations. For almost, I'm not sure how many states in the U.S. now allow, but Hawaii, Montana, Washington D.C., I think Virginia. I mean, there's lots of states that allow domestic captives to be formed. There are also, most people know, most popular places are Bermuda, Cayman Islands. They are more in the Caribbean islands because of the regulatory requirements that are there. And again, they're set up for specific purposes. Other considerations in domicile, at least for UC and some others, it might be perspective of because one of the things is you actually have to have a meeting, annual meeting, and wherever you have the place domicile. And at least for UC, it may not look good. One, if we are going to the Cayman Islands to have a board meeting, or even to Hawaii, just the optics of it. So that also has to be part of the consideration of where you're domiciled. So we are domiciled in Washington, D.C. It made sense for us because we also have operations in Washington, D.C. And also based upon the types of lines of coverage, it also made sense for us. So all those things are part of the consideration. Now, those are the types of things of, kind of the rate setting, if you want to call it. The other issues that you need to consider are dedicated management resources of parent. In order to operate the captive, typically you're going to have people administer the claims. You're going to have other people, the accounting, the financial accounting. You're essentially setting up another company. And so a lot of times the resources of the parent company will be used to help do that. And so the understanding has to be is that there's going to be a cost associated with that. Obviously, there's consideration for administering the plan, potentially insuring, whether you're an insured third-party business might be part of that. And then the other considerations are financial accounting issues of how the tax implications, all those things have to be considered of when you're going to recognize revenue, things like that. Because it truly is, it's a new company, and the insurance rules are a little bit different as far as because you're holding money for a long period of time to pay for claims. And so there's a lot of implications for the parent company to consider when they decide to operate a captive. So the domicile and issues that I kind of mentioned, this is kind of more in depth, that you'll want to consider, and they kind of have an example, I think, of Utah in the book. So some of the things would be minimum premium requirements, which kind of goes, and then minimum capitalization. These are the two things we just kind of talked about is, is there a minimum premium that has to be set, and then how much money needs to be set aside. Solvency requirements. This goes back to the bankruptcy issue. There'll be issues of how are you going to deal with solvency to make sure that the there'll be money to pay for claims if something does happen and the company goes bankrupt or sells or merges or something like that. There'll be incorporation registration expenses, potentially local taxes. Certain domiciles only allow certain types of insurances to be covered or to be written. The regulatory environment in different states vary. There can be investment restrictions of what type of, the premium that's collected, what can that money be invested in. Ease and reliability of communications and travel to and from the domicile. This kind of goes to the issue of going to the Cayman Islands or Bermuda. How easy is it to get there? How easy from a communication standpoint to go there? Political stability, again, foreign countries, you have some stability issues potentially based on where they're located, especially if you have a change in government where they can say we're going to take control of the banks. That can be an issue. And then lastly, support infrastructure in terms of captive managers, claim administrators, bankers, accountants, lawyers, actuaries, and other services. That, just like an insurance company, you need to have all those people on board, or you need to have contracts in place to have those type of support to be able to manage those operations. So this is an example in the book of Utah. I did include it in there. So Utah is an onshore domicile for many captive insurers, and so here's some of their requirements. Capital requirements ranges from $100,000 to $500,000 depending on the type of captive, and you can do that by cash or irrevocable letter. Surplus, again, you can have based upon a letter of credit might be what's only required. A premium tax, so this is how the state makes their money. They're going to charge $5,000 an annual fee as far as operating the captive in the state. An examination, what this means, a captive must submit an examination by the commissioner every 1 to 3 years. Is that essentially you got to open up your books, show that you have enough capital, that you're fully capitalized, that you're doing the books correctly. So that's what that means by examination. Typically, an annual report needs to be submitted based upon general accounting principles, so that would be a part of the requirement. In this case, we talk about reinsurance. Captive insurers may take credit for reserves on risks ceded to reinsurers if the captive complies with requirements of the Utah Insurance Code. So basically they're saying, hey, if you comply with our requirements we already have for regular insurance companies, we'll take these credit for reserves on risks ceded. And then in this case, a local office, a captive insurer must maintain its principal place of business and hold at least one board of directors meeting each year in Utah. And at least one board member must be a resident of the state. So again, residence requirements, there's all these different issues. In each state, they're going to be a little bit different, and that's part of the considerations of why you'd want to form a captive. So we actually went through fairly quick tonight. With that, I'll go ahead and open up if there's any questions. But the main point, I guess, to kind of recap when we look at on the captive requirements and going back to the objectives on this, is to be able to understand the purpose and characteristics. Obviously, we covered that. The types of captives, the parent, group, association, risk retention groups, you want to have an understanding of those. Advantages, disadvantages of the captives, and then some of the considerations. For the most part, this should be hopefully a fairly easy chapter for most. I think it's fairly straightforward once you kind of understand, that this is your own insurance company that you'd form. And if you think about what would you consider, what would the things, if you want to form your own insurance company, what would, what are the things you need to keep in mind? And the regulatory environment, you think about that, and that's the way you want to approach it on the exam when you get questions regarding the captive, is how would you handle this? Why would you want to do, locate in one location? What would be the coverage requirements, those type of things. And I think you'll do well with that. So if there's no questions, we'll go ahead and call it a night. So thank you everyone for participation. And again, next week we'll have one more. We'll do another class, and then we'll have a break for the holiday break, and then we'll reconvene in January. So good luck and have a great weekend.